My friends, what's up? So today is a very important day. CPI numbers will come out for the month of November. It's going to be very interesting to see if those numbers will be higher than expected or lower than expected or as expected. So we expect a 0.3% inflation in the month of November. We will see. Why is the CPI numbers important? Because it shows where the inflation is going, and if inflation is going down, then we can have the U-turn of the market. So we can go from the bear to the bull market. And if why would that happen? Because if inflation goes down drastically, then you can have a Fed pivot. Fed pivot meaning that they will basically increase. Well, first they will not increase rates as much as they would, like 75 beeps for example, but they will be slowed down to 50 beeps, and that's what expected after tomorrow is a raise of 50 beeps. And if after the 50 beeps, the market now is, of course, it will depend on the CPI numbers we see today, and that's why the increase of rates will happen after the CPI numbers. Like this, Federal Reserve digests the CPI numbers today and takes a decision on if and by how much they will be raising rates. So market expects that if inflation is 0.3% per month, it expects the Federal Reserve to increase the rate by 50 beeps. After that, probably in February, when they have the next meeting, they will increase another 25 beeps, and after that it will stop. And the question is, for how long will Fed stop the interest rates in order or before decreasing them? And that's where you have the pivot, and that's what everyone who invests in the equity market is looking for this information and waits for this moment. After, of course, there's different strategies. There's the average down. You can just take S&P and average down each time it falls. You can do same thing with QQQ, with shares like, you know, the FANGs. You can do the same thing. I mean, the strategy doesn't change, it just amplified, because if SPY, for example, goes 10% down to 10%, then the QQQ having a beta, I don't know, of 2, meaning that it amplifies the market by 2 times, will go down to 200%. Sorry, 20%. Okay, so each going up of 10% of S&P will result in going up of QQQ by 20% with the beta of 20. So that's how you can amplify risk without taking margin. Okay, so that's why you have the strategy. If you think that it's most likely that we are in the pivot times, and you're investing, for example, under a falling knife or averaging down, you think that, okay, the market is so low right now that I will put more money, for example, into risky stocks such as Tesla, which has a beta of, for example, 2 in correlation to S&P. But right now we see that for example, Tesla, the market becomes a little bit more specific because of Elon's activities on Twitter, getting political, and all of this. And that's an example where, for example, yesterday you had the QQQ, which went up like 1 or 1.2%, S&P went 1.5% up, and you had the Tesla, which was down 6.5%. So we will talk about Tesla in a different video if you want me to, just comment. but if your strategy, for example, I mean, your strategy will depend where you think the market is. If you think that we are close to bottoming, then you will probably buy the shares that you can amplify, or the ETFs that you can amplify, such as QQQ, because bouncing off will be much quicker with the QQQ than an S&P. As we said, if S&P goes up 5%, so we have, for example, good CPI numbers, low CPI numbers today, and S&P directly will go up 5%, because you have the algo trading machines which, you know, take the trades as soon as they see that the CPI numbers are lower than expected. Wow, everything, all these algo machines will be buying, and because of the automatization of the financial markets, everyone, you know, including or probably more institutions or institutional buyers than retail buyers will buy in an automatic fashion using the algos. So that's why you will see S&P directly at plus 5%, like in a matter of minutes. So if you see S&P, for example, or if you're banking on that inflation numbers will be good and S&P will go up 5%, QQQ probably will go up 8% or 10%, and Tesla can go, well, Tesla is a different animal right now. We will not talk about it because of the politics and as I said, of Elon's behavior. Of course, it can be a good, if you believe in Tesla's execution, if you believe that demand will not deteriorate with the political speakings and mentions of Elon, then it can be a very good time to invest. But so basically, the CPI numbers, we will see what's happening with the CPI numbers. I personally have like I would say 20 to 30% of my investments in equities, and I'm you know, if the market will go down more, then I will, or CPI numbers will be bad, I will be buying more. So basically my strategy is to you know, buy the dip strategy, because I think that historically we had information that from the moment when Federal Reserve slows down the interest rates to the moment that they are decreasing the interest rates, there's about 11 months of time. Of course, that depends if the you know, the yield was inverted or not, which now it is, and that signals that there will be a huge or that signals that shows that you can have a crisis, you know, and no one wants a crisis. And if crisis happens, actually we're at a time where bad news will be good news for investors, because of course with the crisis everything will go down, but the inflation will also go down. So as inflation goes down, the interest rates will go down, the discounting factor of net future flows of the company will go down, and the net present value therefore will go up. So even the crisis, I mean, every news is a good news, you know. If the CPI numbers are bad or higher than expected, then the market will go down. I will just buy the dip. And if the CPI numbers are good, my equity investments will go up, because you know, everyone will expect, or it will become more clearer that there's a pivot which will happen sooner than later, because of the if the trend continues, and because of the good inflation numbers. So that's my 2 cents on the current market. Let's see what happens with the interest rates. Not financial advice, of course, I'm just saying what I'm doing. I think that it's good to invest approximately 1/3 of your money right now. Of course, everything depends on your situation, if you need the money, if you don't need the money. In my advice, if I can give a friendly advice, you know, not financial advice, is that if you need the money in a year, in 2 years, then you should not be even investing that money. You can only invest money that you don't need for the next 5 to 10 years, which is just getting eaten away by the inflation. And I would invest 50 in stocks gradually. The more down it goes, the more I invest, you know, go to 50, 60, maybe maximum 70% if we're in a huge crisis. But I would not go. I would always leave 20 to 30% in cash, because you never know. You know, Buffett style. If the market goes like super low, you can always buy another 10 to 15%. Okay, guys, stay safe, invest safe, and see you in the next one. Bye, guys.